Ian Shepherdson is here. Steve, don't go anywhere. Founder, of course, chief U.S. economist at Pantheon Macroeconomics. Your expectation for what we're going to hear at 8:30, but more importantly, translate that for maybe what you think it does to the Jay Powell school of thinking and the rest of the market.
Yeah, so every time we've had a big upside surprise in the last couple of years, the next month has been a downside. So I'm assuming the pattern continues and I've got a downside. So I'm looking for 125, 150, something like that, a bit below the consensus. The range of forecasts.
And then does the market love that?
I think it does, provided the unemployment rate doesn't somehow drop back down again. The market wouldn't like that. But if unemployment hangs around that 3.8 mark, where we've been for the last couple of months, and the payroll number is 125, 150, you know, that would play well. I think that would allow the market to hold the gains from the last few days.
Okay, that's the equity side of the universe.
Yeah, bonds would probably like it as well, up to a point.
Because?
We had a nice rally. Bond market really wants to see some sustained evidence that that pressure Steve was talking about is diminishing. And I kind of think that is where we are now, in reality, whatever the numbers say any given month. I do think that pressure is beginning to fade. You can see it in the wages data, you can see it in the business surveys, and it's starting to come through.
Okay, so but with all this fading, and you play this out into 24, are you then in a recessionary camp?
Close. You know, this is a very weird economy. You've got the Fed raising rates against a private sector whose finances generally look in pretty great shape. So you've got the Fed pushing, and you've got the private sector kind of pushing back, which you've never had before. So it's very uncertain as to how the dice are actually going to fall. I mean, I do think growth is going to slow a lot. Whether that tips into an outright recession, I think, is kind of a 50-50 call. But I'm pretty convinced it's not going to be a bad one. If it happens, it's not going to be a bad one because the private sector is not in the sort of condition where you need a big correction, you need a big change in behavior. So it's light years away from where we were in, like, 08, but even better shape than we were in 1990 or the recession of 01, and they were very mild.
But do you think that the market's already baked in a recession, and therefore we're, like, almost, I don't want to say almost past it, we're, like, almost past it because it already, it hasn't happened, but it's, like, happened in the head of...
Look, if they had baked in a recession, we would be in a recession, right? Is that... I kind of think that businesses... They were on their guard, and this is, again, a cultural, psychological question, because if you are sure a recession is coming, you pull back your production, you pull back your hiring. They didn't do it. I think they maybe did less than they otherwise would have. But if you look at not just the predictions of the recession, but the hubris and the certainty of the recession that was about to come but did not arrive. I was interested in your interview with Mr. Harvey there the other day, Professor Harvey, just in the last hour, who is so certain that the savings have run out from consumers. Okay, give me $1 for every time that they've told me the savings have run out for consumers. They haven't. They're also, I think, underestimating the importance and the power of wages and employment on consumption. So I'll leave it there. It may happen. It may happen next month, but it's not happened.
Yeah. You know,
is it coming in for sure?
Nothing's coming for sure.
Okay,
thank you. One thing I've learned over the last 3 years is that nothing is certain. Things that you thought were impossible will happen over and over again, and things that you thought would be certain don't happen. So that's the lesson of the last 3 years. This is why Jay Powell keeps talking about how forecasters have to be humble. I mean, it's not a coincidence that he's talking about this.
But here's a related
Didn't Jim
question.
Morrison say the future's uncertain, the end is always
So
clear?
at the very tippy top of the show, Joe made a very important point. We were just talking about we're in November. A year from now will be a presidential election, right? Like, we'll actually. So where
everyone's just really thrilled about it.
But where do you think the economy is come September or October? Then of next year.
Okay, so I think that whatever happens in the next 6 months or so, it's probably on the way out of that by the time the election comes around. But I don't think we're going to be seeing an economy at election time that's either in meltdown or in some sort of boom. It's going to be kind of meh, you know. So, and I can't. That's my story for the whole of 2024. It starts off really meh, and it's a little bit less meh by the end of the year. It's not going to be a great year, and we'll probably have a higher unemployment rate, but we will have much lower inflation. Much lower inflation.
But okay, so if that's the case, Ian, I'm going to paint a different picture, and this is the clip they're going to roll back a year from now when it's terribly wrong. But anyway, you just said inflation's coming down. If inflation's coming down. It's likely the Fed is cutting rates.
Yeah, oh, absolutely.
The Fed is cutting rates. All of a sudden, the fear from Professor Harvey of the meltdown in the banking system from the banks and what's on their books kind of goes away and eases back. Banks might begin to lend. We could be that scenario starting from the foundation of lower inflation could spin a much more optimistic story. No?
Probably for 25 rather than 24.
Okay.
I think, think these things take a long time to work through. That's the other thing we've all forgotten.
Right.
We're all very impatient. We want things to happen quick.
Right.
But monetary policy works.
But you're in the camp. Hold on. You're in the Steve. So are you now like the Gunluck camp of thinking that we're going to really cut rates like 200 basis points? I mean, that's it.
I'm not 200 basis points. I'm more in the, you know what? I don't think the Fed is going to remain on a real basis tougher than it needs to be. It will have to automatically or axiomatically reduce rates because if Ian is right, inflation comes down, the Fed doesn't want to put that much pressure on the economy. It will ease back gently to provide either a stable or a slightly lower real rate.
Yeah, no, I agree. I think they're going to cut by about 150 next year, but they're not going to...
That's a lot. That's a lot
it is a lot,
where the market is.
And they're not going to flip, and they're not going to say anything like that until the last possible second, because they want to retain that optionality after the whole transitory fiasco. They can't be wrong again in the same direction about inflation in the same cycle, because then it looks like you didn't learn from the first mistake. So they hold on to this line until they can't hold it any longer.
They'll make new mistakes.
And then they flip. Yeah, maybe they do.